Our studio in New York City. I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. Here's what we're watching this afternoon. Markets searching for direction with an hour to go in the trading day. The rally losing a little bit of steam, the Dow pulling back from earlier highs, but still on track to close at a new record. And the S&P 500 is treading water. It's less than 0.5% away from its all-time high.
Plus, Apple getting a victory in court over its watch ban. The tech giant now allowed to sell its watches while the court battle continues. We're following the latest developments.
And another legal battle just getting started. The New York Times suing Microsoft and OpenAI over copyright infringement. We're looking at the implications of this lawsuit for big tech, AI investors, and content creators. Let's get you up to speed on the market action right now. Just a few days to go, of course, before the end of the year. And if you take a look at the major averages here, we are not seeing a heck of a lot of movement. The Dow did touch an intraday record here, and it looks like it could close at a record as well. In the meantime, the number to watch for the S&P 500, 4,796.56. That would be the number to beat to close at a new record. Obviously, right now, the index is lower, and so it's not going to get there, at least not if it closes right here, but we'll see what happens in the last hour of trading. Right now, consumer staples are leading gains. Energy is declining, but it's one of those waning days of the year where things are just kind of muddling around. Not a lot of news to drive it.
Muddling.
Muddling.
Well, let's get to one thing that's not muddling. That's the top story of the day. Apple victorious, at least temporarily here. The tech giant will be able to sell its Series 9 and Ultra 2 watches after an import ban has been temporarily halted by a U.S. appeals court. The ban is in regards to a patent dispute with medical device maker Masimo. Shares of Masimo falling today on that news. Meanwhile, shares of Apple relatively flat. So, Julie, bottom line, this is a win for Apple today. U.S. appeals court pauses the ITC's import ban on some of Apple's watches, which, by the way, are critical because we know analysts say these are the watches that at this point are representing really the vast majority of the watch segment revenue here. So that's why we're paying close attention. And this all coming about because of this patent fight with Masimo, which is in the red today. Tim Cook's company filed this request to halt the order, and the appeals court saying basically, okay, we're going to halt this ban, Tim Cook, while we think over Apple's motion for a longer pause during the appeals process. Yeah,
January 10th is now the deadline that the appeals court is giving to the commission to respond to the longer delay or stay for that court challenge. And then the other date to watch is January 12th. That's when the U.S. Customs Agency has to determine if some of the tweaks that Apple has made to the watch are sufficient to, make it not subject to basically, that's what it says. So that's the next date to watch. But really, all of this comes back to sort of a long, complicated back and forth between Apple and Masimo, an executive who used to be at Masimo who came over to Apple, but that's not the only one. There's a number of employees who have come over. So there's a lot of back and forth between the two companies. And, it's unclear what exactly is going to happen in this situation. Yeah,
there's a lot of fun drama in the story. For investors, the key question was, okay, listen, if this ban went into effect here, what kind of impact would it have? What kind of revenue impact? And we spoke to some very smart Apple analysts. We had Ben Beharin on this week, and when he would crunch the numbers, I guess his real conclusion was, listen, he didn't think this was going to be financially material. It's hard for anything to be financially material when you're a company Apple's size, but it's interesting because it's in this moment, this context, Julie, when Apple's trying to get that top line growing again. You've had 4 quarters of declining sales. If you're a bull, you're betting on that. So that's why, certainly you see these headlines and it's not good. It's not a good headline, and it doesn't help as you try to get that revenue moving in the right direction.
And I think the other key thing here is that a number of companies have attempted to bring these kinds of patent disputes against Apple, and this one has gotten further than ones before it have gotten. So
for sure.
Is that, some kind of more broad-reaching change? I think that's arguable, but it is interesting that it has gotten as far as it has because Apple has defended itself staunchly and successfully against these kinds of challenges. In
Yeah,
the
you know,
past.
and we think about Apple, and obviously still iPhone bread and butter, but that watch segment, of course, Apple doesn't break that out. But, you know, financial analysts will estimate it probably is about 5% now of total revenue, so it's meaningful. That's why, you know,
Yes.
you pay attention to it.
Yes, for sure. Let's broaden it out and talk about the markets right now. The Dow is fighting for another record close before the end of the year. Optimism over rate cuts has been driving the action as of late. The market betting on the first rate cut's going to take place in March. Our next guest says the market has maybe gotten ahead of the data, even as the overall landscape has improved. Joining us now, Adam Phillips, EP Wealth Advisors, Managing Director of Portfolio Strategy. Hey there, Adam. So how many rate cuts do you think are going to happen? When are they going to happen? And is it going to be a big disappointment for the market if it's not what is already being priced in?
Sure. Hi, Julie. You know, I think if we look at the market, it's obviously animal spirits are alive and well. It's been 2 weeks since Jay Powell really delivered that early holiday gift to the market, and the bulls have been running with it. I think the question is, have things gotten a little bit too far? We're still watching the data, and you know, markets, if you look at what the bond market is pricing in, suggesting perhaps as many as 6 or perhaps more than 6 rate cuts between now and the end of next year. I would say our base case would be closer to 3, maybe starting as early as March, possibly, but potentially after that. And so I think it's going to take some time. You know, we're going to be getting some data that I think is still supportive of this economic growth. We know the Atlanta Fed GDP now data is suggesting 2.3% growth for this quarter. And so I think a lot of this story of economic resilience is going to remain, and I think that's going to keep the Fed. I think that they'll need to maybe perhaps talk a little bit more hawkishly than they have been doing. We've seen them try to walk back some of the comments over the last couple of weeks that were made in the FOMC meeting. And so I think it's about just right-sizing the expectations with the street. So that's really what we're focused on. I'd say that the likelihood is that we're going to get closer to 3 cuts between now and the end of next year.
And hey, Adam, I'm just wondering, do you think, you know, I really just need, as an equity investor, to watch the yield on your benchmark 10-year. You know, as long, Adam, as that stays sub 4%, we're here at, where are we, 3.791. As long as that's sub 4%, the equity market can work. Is it that simple?
I think that's been a huge driving force behind this rally. We know that a lot of the move here has been in response to Jay Powell's comments a couple of weeks ago. But there is obviously a correlation here. And what's most interesting to me in that this rally that we've seen, it's been driven by the broad market. We've actually seen those Magnificent 7 companies underperform here over the last month. And so we certainly welcome this broadening out, this wider participation of the market, and where these companies that, you know, the Magnificent 7, a lot of people think of them as growth companies. They're actually synonymous with quality. They have strong balance sheets. And so we saw them as more of a safe haven trade when the 10-year was rising. As it's been falling, we see that's created an opportunity for other sectors, for smaller companies, those that might not have that balance sheet strength and might have more floating rate debt obligations. And so I think that's really going to continue to drive things here. And it's, you know, I think just, you know, the other thing that we are watching is as we get past the holidays, I think the big question mark that we're, you know, something that we're keeping an eye on is, will there be this holiday hangover? Now, after all of this excitement fades, this exuberance that we've seen really starting from that FOMC meeting a couple weeks ago, will investors start to just kind of take a look around and say, okay, things have maybe gone a little bit too far. Let's focus on not just the 10-year, but also some of the cracks in the system that we do want to be mindful of in the months to come.
What are those cracks, Adam? What should people be on the lookout for?
Yeah, look, I think that, you know, one of the things that we're watching is the fact that delinquencies are rising. If you look at certain areas of household debt, I think one that's you know, been talked about a fair amount is credit card delinquencies. Those are on the rise. It suggests that even though we've seen consumer spending appear quite robust here and show a lot of resilience, maybe people are starting to feel a little bit more pressure here. And so that's one area that we are watching. Another one is, you know, we are seeing the fact that on the corporate side, there are more maturities coming due, some debt that's starting to roll over, not as much in the large cap space, those higher quality sectors. But I think things like this will start to weigh on earnings going forward. We're still thinking, you know, looking at analyst projections of double-digit earnings growth, something around 11 or 12% in 2024, and to me that just seems a little bit too optimistic, and so we'd look for that to come in a little bit just to help to justify these valuations.
And Adam, switching gears a bit here, I wanted to get your take on gold, if I could. You look at gold; it's had a move this year. It's up about 14%. Adam, when you're talking to your clients, do you tell them, listen, you should have gold in your portfolio, 5%, 10%, and kind of dial it up or dial it down depending on the environment?
Yeah, that's a great question, Josh. So we've actually had commodities in the portfolio. Up until recently, we had broad commodity exposure. That was really our inflation play. It was broad. It did include precious metals like gold. We do not have that exposure anymore. I think that gold could become a little bit more interesting here. And many see it as an inflation hedge. It's a nice hedge against this geopolitical uncertainty, which we continue to face. But I think that when we are looking at rates that are yields that are falling, it actually does make yield a little bit more attractive on a relative basis, because as we know, yield doesn't provide any income. And so it's really hard to justify it when rates are on the rise. I think there could be a place for it. We are looking more broadly at alternatives, though. I think that the name of the game just going forward is going to be diversification, whether you're focused on just your equity asset class within large cap, getting outside of those Magnificent Seven companies, those that have been leadership for so long, and then looking at other asset classes as well. You want your fixed income. I think that the 5% return we've seen on the aggregate index this year just is a good reminder to investors that fixed income still does serve a role in portfolios. But then I think there's also an argument to be made for including different types of diversifiers, these alternative assets that may include things like commodities, precious metals, or even these less liquid types of investment strategies that we've been looking at recently.
And Adam, when you talk about diversity, let's talk equity specifically. What sectors do you want to be in right now going into next year?
Yeah, so for a while we've been favoring industrials and healthcare, shying away a little bit from staples, utilities, real estate, those that are more yield-oriented sectors. But I think as we look at the economic landscape, there's no denying this resilience that we've seen. And I think it's hard to, maybe investors have taken the Fed's comments a little bit too far, but we certainly don't want to fight the Fed and try to argue against what they are obviously seeing and apparently optimistic about. And so because of that, we are also becoming a little bit more bullish on consumer discretionary. So that's one of the newer areas that we're starting to look at a little bit more. We're looking at the fact that inflation is coming down. Employment is still holding up pretty well. It's kind of this Goldilocks environment. And so to the extent that the labor markets can remain strong, I think that'll support this discretionary spending among consumers, at least over the foreseeable future.
Adam, thanks so much for joining us today. I always appreciate your time and insight.
Thank you.
Now checking in on some of today's trending tickers. Shares of Tesla riding high today on news that the EV maker is prepping a revamped Model Y to be built out of its Giga Shanghai plant. It's according to Bloomberg. The updated Model Y will have much more obvious exterior and interior changes than the most recent China Model Y update back in October, which added a new wheel design and ambient lighting. So per Bloomberg, Julie, the mass production could start, according to their sources, as soon as mid-2024. Shanghai, by the way, I didn't realize this, now producing over half of Tesla's global deliveries. Obviously, Model Y, very, very popular, one of the best-selling EVs out there, especially popular in China, by the way, where we though know, of course, Tesla does have plenty of competition from names like BYD, among others.
Yeah, so there's the Model Y news, and let's be clear here, when we're talking about any single stock on the waning days of the year, yeah, sure, it's up because of this story, right? But you get also a lot of people positioning in the last days of the year, buying things that they didn't have enough of and, trying to catch up, et cetera, or lightening the load. So that's sort of the caveat as we talk about some of these movers. But another couple of things caught our eye on Tesla. One is a note from our friend Dan Ives over at Wedbush, who we're going to be talking to on the show later in the week. And the other comes to us from Adam Jonas of Morgan Stanley. Now, Ives in particular is zeroing in on the delivery targets for Tesla. And he says Tesla is tracking slightly ahead of the 480,000 delivery unit bogey for the fourth quarter. He's optimistic for how the numbers are going to look for the whole year. And then Adam Jonas's note is really interesting reading as well. He dives into the debate over whether Tesla is just a car company, right? Is this just an auto company? Is it something more? He contends it is something more. It wouldn't have been priced how it is
if
both,
it
wasn't.
He says.
Yes, exactly. And he talks about that the company's valuation here. He says $380 price target. The valuation of the core auto business, he says, is only $86 a share.
Yeah.
I mean, he's long talked about this, as have so many bulls on Tesla, that it really is the AI, it's the autonomous driving, it's all the other stuff that makes it attractive as well.
Yeah, it was interesting as part of his bullishness, and it was a great note. Was also just based on what the rivals do in competition. He just sees them delaying their EV-related investments, and long term, he says, hey, that's runway for Tesla.
Right. So some interesting reading on the company today. Let's also talk about what's going on in the cryptocurrency space today, because there we see some trending tickers as well. More importantly, of course, there's also the ongoing battle between crypto-related companies. Coinbase, MicroStrategy, Marathon Digital Holdings all higher today. This after MicroStrategy announcing it bought $615 million worth of Bitcoin as expectations grow that U.S. market regulators will soon approve a spot Bitcoin ETF. As we know, the company has been bullish, and Michael Saylor, who is the chairman, has been a crypto preacher, if you will,
Yep.
in some ways, a proselytizer for crypto. And so if you look at the total holdings of Bitcoin on the balance sheet of MicroStrategy, it's over 189,000. That's almost 1% of all of the Bitcoin that are out there are held by this one company.
Yeah, I mean, some investors, listen, they don't want to hold Bitcoin directly, so they want to be kind of Bitcoin adjacent, and they look to MicroStrategy. That stock now, by the way, up about more than 350% this year. Bitcoin, meanwhile, also has had a big run in 2023 after a rough 2022, but now up about 150% this year. One question has kind of been, if Julie, if and when regulators really greenlight that spot Bitcoin ETF, what would that mean for MicroStrategy? Saylor has told reporters, not surprisingly, perhaps, he doesn't see it as a threat because, listen, he says its stock is a leveraged bet with no fees. But listen, depending on what the SEC does, maybe we'll soon find out. Well,
and we'll see what the fees are on those ETFs if they do get approved here. Marathon Digital, by the way, is up for the 11th straight session.
Yeah,
it's up, I think, more than 1,000% this year. I mean, coming from a low base, it's a Bitcoin
longest
miner.
winning streak on record.
Yeah, and
it's only up about 800% this year.
Yeah, I mean, Coinbase is also up in the triple digits on the year. So it's been a good year for those crypto stocks after what was not.
After a rough 2022.
Yes, exactly. And by the way, in the 4 p.m. hour, we're going to continue to break down what to expect if that Bitcoin ETF is approved. We've got Bloomberg senior ETF analyst Eric Balchunas and Sam Enzer, Cahill Gordon Rendell, LLP partner. He represents folks in crypto, so should be a very interesting conversation. Meanwhile, we're just getting started here on Yahoo Finance Live. Coming up, the race for the presidency will reveal the 3 outcomes of the 2024 election cycle, regardless of who wins the White House, which you need to know as an investor, and a new installment of our series, Goodbye or Goodbye. We're going to take a look at real estate stocks and tell you which is a buy and which to avoid. Plus, crackdown on chatbots. The New York Times is suing OpenAI and Microsoft for copyright infringement. We'll dig into the suit with an AI expert after the break.
The New York Times is suing OpenAI and Microsoft for copyright infringement today. The media giant alleging millions of its articles were used to train chatbots in a potential landmark lawsuit that could set precedent for the news publishing industry. Joining us now are Nikita Roy, University of Toronto generative AI specialist, and MIT professor Sinan Aral. Welcome to you both, guys, and thank you so much for joining us. Nikita, I'm going to start with you on this. Listen, we've heard this criticism for some time now from authors and comedians and publishers over who exactly owns this data, owns this content. One, Nikita, were you surprised that the Times brought this lawsuit? And two, give us your thoughts on it. What'd you make of it?
Yeah, I was completely expecting this to happen actually for a long time. And I think the New York Times doing this is really helping a lot of the media organizations who probably don't have the ability to go out and take on these tech giants. But the issue of copyright really is really so complex, and it comes down to how the courts are going to define generative AI and specifically large language models, because who is liable in this case? Is it considered a tool, or is it the user? And the problem is that large language models and all of these tech companies like OpenAI and Anthropic by Cloud, they are completely shifting in the way they are thinking about these large language models. So one of the things that I think really is important to take note of is last month, OpenAI CEO Sam Altman said in his keynote speech that they would defend their customers and pay the costs incurred if they face legal claims around copyright. And so I think that really shows how confident maybe the tech companies are regarding their claims to make sure that these are considered just as tools and push that liability over to users. But at the end of the day, we're really facing a very ethical issue in terms of how are we going to be using people's work and take away that and be a competitor in that space as well.
And Sinan, I want to bring you into this because as someone who both studies these issues but also invests in startups that use AI, I'm curious, when Nikita talks about that some of these companies are ready to face the cost, how substantial do you think they could potentially be for both smaller startups and really big ones like OpenAI?
Well, I think that the costs could be very large. Julie, it's great to see you. Happy holidays. This is a debate between whether the companies training large language models on content from the web, the New York Times, and content from lots of other places is fair use or infringement of copyright. And if the courts or a settlement determine that there need to be payments made to the original producers of the training data, that could increase the costs for AI, generative AI companies, generative AI startups, and that makes a big difference for how the industry runs. However, this was expected, as Nikita said. So these costs in large part have been planned for, have been thought about, and it's not something that is brand new. This has been a debate that's been ongoing for months, if not the better part of a year. And this is just the first opening of the conversation. And really the determination will be, where does the price point lie? Is it going to be a very large transfer to those who are creating the content that the models are trained on, or is it going to be smaller? Is it going to be settled, or is it going to go to court and have judicial case law created about copyright infringement based on this particular case? We will see. However, this was inevitable, and therefore, I think a lot of these costs have already been thought about in the long run.
But Sinan, let me just get your take, because we do know tech companies have kind of made the case before, right? And it seems like their argument is this is publicly available information. We're scraping from the public internet. It's just oceans of data, oceans of text. So it is fair use. Do you buy that argument?
No, I don't buy that argument, and it depends on how you use it. So if I were to take New York Times articles and start a website, sinanaral.com, and post New York Times articles on my website and charge for them, that would be copyright infringement, even if I scrape them from the web. That is not considered fair use. If I were to, however, copy a single New York Times article for one class at MIT for educational purposes, that would likely be considered fair use. and training very large language models on millions, as the lawsuit indicates, pieces of content by the New York Times is a new use. In other words, it hasn't been considered in the past as being a traditional use of copyrighted material. And therefore, we have not decided as a society whether this is fair use or not. And that's why this case is so important, because it will decide either through case law or through settlement how much we believe content producers deserve in terms of the use, this type of use of their content. And that's what's new about this case.
It's also quite interesting the speed at which all of this is moving compared to, say, regulation of social media, right? You see these court challenges happening rather quickly. Nikita, I want to shift gears a little bit because I know you concentrate a lot on the intersection between technology and journalism, and specifically AI and journalism. And it seems to me journalism has faced a lot of sort of existential threats over the past decade, at least. The people you talk to, how are they facing and thinking about this latest challenge?
I think the biggest issue really is that the hard work of journalism has been taken and been pushed into these large language models and can be reproduced so easily. And we have, first of all, the biggest issue is of misinformation that could be spread, but also what does this do to the business model of journalism that relies on people coming to a website, clicking on a story and reading, either behind subscription paywall or money that's made by advertisements. So what happens to the business model? And I think there's a lot of concern within the industry right now in terms of how do we innovate and go forward with the business model? How do we change the user experience? What does that look like? But at the same time, it's also, are we going to be kind of cut short for a deal again by tech companies? They already did that with social media when we saw that in the era. What's going to happen now in the generative AI? But I think one of the most important things that has been promising has been these deals that have been struck with publishing companies. OpenAI did that with AP. They did that with Axel Springer. Are we going to see more of these deals where publishers are now going to be compensated for their work? In the platform era, that conversation was actually left quite for a long time. But I think that conversation's ahead now, and they know that tech companies, AI companies can't treat the platforms as the same way they are doing by leaving those conversations for later time. So I think we'll need to talk more about how are we sourcing the data? Are we ethically sourcing the data? For example, like the Adobe's generative AI Firefly model, like they ethically source their data, and people are compensated. If you're part of like Shutterstock's Creators Fund, you get compensated if your images were used in training data. So for example, all of those conversations is what we need to have now, is how are we going to be compensating publishers, creators, honestly, anybody who puts any content up on media online is at risk of their knowledge basically being mimicked and produced into a different format to go online. And that's the big question we have to be asking, is they are language generators that are going to be mimicking knowledge that people are going to be putting out online, and does that knowledge get compensated for?
And Sinan, help me thinking through this, because if the New York Times won this, Sinan, would that mean that an AI company would have to go out and license material from each and every writer, author, creator, publication that posts on the public internet? I mean, one, am I thinking about that correctly in your opinion? Because it seems like if I am, I have a hard time believing a judge would make that decision. And two, it just seems like a decision that would have really huge ramifications for AI, just as we're in the kind of early innings of this tech.
I think the answer is yes. If the judge in this case were to go all the way to a trial and were to issue a decision on some sort of motion that said this is copyright infringement, then all content creators that are posting on the web that find their content inside the training data sets of a large language model would have very similar claims to for compensation. I think that would be a very large cost up front, but I think that what would happen next is that the AI companies would seek alternate training methods in order to minimize that cost. So they would need to retool They would need to think about how to train their models without sourcing expensive human-generated content. And it would create a shift in the industry in terms of how these models are trained. In the short run, what I think you will see happen is more deals like the ones that you have seen with AP and Politico and other types of companies that are saying, hey, you know what? We're willing to take a deal with OpenAI and with Microsoft and to be paid for the content that we provide through a contract for their training models. And I think that you'll see a lot more of that going forward. And I think that that price point will be negotiated such that content creators get some fair value for their content creation. And companies like OpenAI and Microsoft minimize the costs as much as they can of the inputs to their models, which is exactly what we've seen over and over again as technological innovation marches forward. One thing I want to make clear is that this is not the first time that we are seeing technology substitute for a prior form of production. And I think that it won't be the last. And I think that our society is learning how to cope with what is known as skill-biased technical change. As technology advances, it substitutes for some skills and it complements other skills. And typically the economy responds and labor markets respond by doubling down on those skills that are complemented and substituting skills that are substituted.
Interesting stuff. Really helpful perspective. Sinan, great to see you. Happy holidays. Nikita, great to meet you. And thanks so much to both of you. Appreciate it.
Thank you.
Coming up, time to help navigate your profile in your portfolio in the latest edition of Goodbye or Goodbye. Stick around, you don't want to miss it. It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye, brought to you by E-Trade from Morgan Stanley. Our goal to help cut through that noise to navigate the best moves for your portfolio. And today we're scooping out the real estate space, a sector that has gained renewed attention as interest rates have come down. I'm here with Jay Hatfield. He's Infrastructure Capital Advisors CEO. Jay, thanks so much for being here. Appreciate it. So let's get straight to your buy stock, your good buy today, which is Boston Properties. And as we kind of talk through this, one of the things that you're looking at is that interest rates will come down, but you kind of have a little bit of a different flavor when we're looking at that, because you're looking at what the Fed is doing versus what the ECB is doing. Why is that important for where rates are going and then the feed through to REITs?
Well, Julie, what a lot of U.S. investors don't realize is it's really a global bond market. It's fine to just focus on U.S. stocks because we really dominate the whole world. But bonds are fungible, they have low default rates, and so it's a global market. So we actually started focusing on the fact that rates are running up, and we said, why? Well, it's because the ECB is so tight. Well, if they're so tight, their economy can't be doing well. And when you really look, it's terrible. It's 3% below what the U.S. is running at. So they have a negative growth last quarter. It's tracking at negative 1.2. So we're bullish, unlike a lot of strategists, that the ECB will cut. We're worried the Fed will be slow, but if the ECB cuts, global rates will drop, and that'll benefit our markets. We're not dependent, like most people are, on the Fed, because we look at all the global bond markets, which really drive interest rates.
Well, real estate investment trusts tend to be interest rate sensitive and benefit when rates come down. So that's one of the things you're looking at when it comes to Boston Properties. But I want to talk specifically about office REITs, right? And why a company like Boston Properties, because offices have not been in favor.
Right.
So why is that going to change?
Yeah, so offices in general are really well hated, as some of them should be.
Yeah.
But the distinction that has to be drawn is between really A-plus offices like we have here in Manhattan. For instance, Boston Properties owns what used to be called the General Motors building, so like a real trophy asset. And for the sectors that they cater to, like financial services, they do work from office. When I started on Wall Street, we did LFO, which is live from office. And so unless you want to be fired in financial services, you do go in. And AI, when you talk to brokers, is a very in-office. That's all hands on deck, also LFO. So we think the fundamentals are improving, but only for A-plus buildings. We're not saying run out and buy every office REIT. This is the best, largest premier developer in the United States.
Gotcha. And then you're also looking at the valuation here. Your price target, if you look at the funds from operations, which is a measure of cash flow that folks look at when they're measuring REITs, your price target on that basis is $94.
Correct. Yeah. So we think that another way to look at valuation is just it's a simple number. It's the cap rate. So that's just the cash return on investment. So normally these trophy office buildings used to be at 4 to 5% cap rates. Now they're at 7. And so we think there's 20 to 30% as they start to catch up to where they were before. And in fact, BXP is down 50% since the pandemic on a price basis.
Yeah, and one of the things we like to ask folks is what could go wrong with this bullish case here? And, you know, maybe we don't see rates go down at the at the
Yeah,
pace.
so we are probably have the highest target on Wall Street for the S&P. So we're at 5,500, which is a Goldilocks scenario, 2% growth, falling interest rates. So particularly if rates did not fall, let's say the ECB doesn't cut, which is, I guess, possible, not prudent, but possible. I could definitely see the Fed not cutting and maybe rates go higher. And BXP and most REITs are more than 50% correlated with interest rates. So you're absolutely not going to make money unless rates keep dropping.
Gotcha. Okay, so let's get to the stock that you want to avoid, and that's Prologis, which has done very well, right? And that's part of your case. But what we're seeing now, and Prologis is an owner of warehouse space. And so you say now, as we're seeing the pandemic boom sort of slow down, online retailers are not expanding as much in the warehouse.
Correct. And then the other thing that, if you really think about warehouse space, it's easy to replicate. So if you drive on I-95, you'll see a lot of Prologis, but very difficult to replicate office. So there's very few, if any, offices being built, but a lot of new space coming on. And as you mentioned, Amazon is trying to optimize their distribution. So it's not like it's terrible, but this is a premium valuation, which is another point, I guess.
Yeah,
but,
let's talk about that real quick, because I did look at a chart here of these price to FFO, that measure that we earlier talked about. Here's Prologis, and this is a 5-year chart, it's a longer term chart, and here's BXP, which sort of looks at that valuation gap.
Yeah, so they're trading at 24 times, BXP's at 10. And again, you know, if you think the other way to look at it is cap rates, that they're going to compress, because these are both trophy properties. If you've got these CBD in the gateway cities, they're going to be worth a lot at some point if the fundamentals improve, just as they are for PLD. So we think that the gap will close, but we're not really saying short PLD, because we think that BXP will come up and get closer to PLD.
And then your final point on this one too is that you think small caps are going to do a bit better, and Prologis is now the largest REIT by market cap.
Yeah, it's 11 times bigger than BXP. So it's defensive, just like large cap tech is. So it's where what people buy, or hedge funds will go long PLD and short office if the market's bad.
So what's the risk to this bearish call here? It's kind of the flip
I would
of the
say,
other.
well, you know, the interest rates are tough, but also if there's a recession in the U.S., you'd really want to be in PLD. It's more defensive. Office space is very variable. We think the cycle's over, but financial services companies lay off. We saw tech layoffs a couple years ago. So if we have a major recession, office employment will get hit harder than just warehouse space. And also the occupancy right now is higher on warehouse. So it will act defensively, and you really should have flipped the goodbye and goodbye.
and just quickly, what's your positions in the two stocks?
Yeah, so BXP we hold in our large cap dividend fund, ICAP, and also in our hedge fund. And then thankfully we have no position in PLD, so sometimes we actually will have small positions in companies we think will underperform, but we don't have any position in PLD.
All right, Jay, I'm going to sum up what we have talked about here. We're going to recap. You're telling investors to buy Boston properties based on attractive valuations, expectations for strong leasing demand for office buildings, and REITs overall continue to rally, offices in particular. On the other side, you're saying avoid Prologis, the warehouse boom slowing down, online retailers aren't spending as much, and the stock's valuation looks full. Jay Hatfield, thank you so much for being here. Really appreciate it.
Thanks, Julie.
All right, and thank you so much for watching Goodbye or Goodbye. We're going to be bringing you new episodes 3 times a week at 3:30 p.m. Eastern. We'll be right back. As the S&P 500 climbs near a record high, the money is following. Jared Blickery here with that story. Hey, Jared.
Hey there. I thought this was an interesting tweet from Ryan Dietrich that we have created this nice image from. First of all, he's just outlining all the bullish things in the market right now, and I'm going to add a few more. First of all, stocks at an all-time high, true, gold at an all-time high, home values at all-time highs, and I thought I'd run through the list of tickers here. These are just on our regular Yahoo Finance website that are at record highs. SMH shaking your head, no, that is the semiconductors. They are up 73% this year. Then we have home builders. Then we have the tech sector overall, that's large cap tech. Then the Nasdaq 100, these two virtually the same in returns. Then we have an industrial, this is an infrastructure ETF right there. PAVE, you like European financials? Those are up 20%. They've been dead money for decades, but now they're coming alive. Gold up 13%, also at a record high. The Dow, we also have transportation, defense stocks, and also KIE is insurance. Yeah, we're going to plot that too. But let's take a look at some of the other things in the market, and we can go back to our list here and way back to Ryan Dietrich's information. There we go. This is household debt to disposable income, and this goes all the way back to the 1950s, and we peaked just before the global financial crisis, worked off a lot of excesses, but what I would note now, we are under two long-term averages going back to 2000 and all the way since 1984, although if you go back to the 1950s, we are slightly above that average. But suffice to say, the U.S. household sector is not nearly as levered as it once was just a decade and a half ago. More Americans than ever are owning stocks. You can say, well, this is good if stocks are going up, and this is approaching 60%. And what's interesting is that this number had plateaued for decades and only came to rise with the retail revolution and the pandemic trades that arose over the last few years. Here's another one. This is inflows into SPY. This is the S&P 500 ETF, the oldest ETF on the market. You go back to 1993, you have never seen inflows as great as we have seen in 1 month, as we have seen in the month of December, and that is right there. One final closing stock or item on the day. Retail cash on the sidelines. This is at a record high. This portends future gains for the coming year, potentially, guys.
Jared Blickery, thank you so much. Appreciate it. Congress is out on holiday recess, but the legislative body left behind a hefty to-do list for the new year, including 2 key deadlines to prevent a government shutdown. Congress must pass 12 appropriations bills, 4 bills by January 19th, and 8 by midnight, February 2nd, to avoid a shutdown. For more on this, we turn to Henrietta Treyz, Veda Partners Managing Partner and Director of Economic Policy. Henrietta, it is great to see you. So lawmakers, they're coming back to work, Henrietta, returning from this recess. They've got to find a way to avoid this government shutdown and relatively quickly. What's your bet, Henrietta? You think they're going to be able to get it done here?
I do think that they'll be able to avoid a shutdown for the next couple of months. The only thing worse than shutting down is the potential to not reopen. And since we barely have a path to just keeping the government open on an as-is basis, imagine if we shut down and then have to renegotiate an entire agreement to reopen. I think it would be an even harder task than just voting to keep the status quo. So my expectation, as was the case all of 2023, is that with 20% or lower odds, we're not going to see a shutdown in probably the first quarter at least of 2024. We do have those looming deadlines, and what Congress likes to do most is just kick the can. So they have a new speaker. The honeymoon period is effectively over for that new speaker, a Republican from Louisiana. And now we need to be moving forward with short-term spending bills that'll probably be a couple weeks to maybe 3 months at the most at a time. And the only real deadline investors really need to watch outside of headline risk is May 1st. That's when the sequester kicks in, which would trim 1% from defense spending in fiscal year 2024 and 2025. So for investors in the defense space, you might want to watch that area for some volatility around headline risk as we near April 30th.
Well, and speaking of defense spending, there's also a lot of requests in, Henrietta, for spending to support our various allies, from Ukraine to Israel to Taiwan. There's also, of course, a lot of requests for funding for border security. How is all that going to play out, especially as you suggest the honeymoon period being over for Speaker Johnson?
Right, absolutely. So there's $106 billion supplemental emergency request from the White House. The Senate took that up. Their version is about $110 billion. And the House is nowhere on any of those numbers. So what the White House is hoping for, along with Democrats and Republicans in the Senate, which has been overwhelmingly bipartisan in a way that we haven't seen since really 2018 for all of this year, they support the same kind of long-term full year package that the White House does, because of the instability of the House Republican Conference and because of the clear fits and starts that we've seen from them for the last year. What they're hoping for is, a full $64 billion basket of aid for one time, one vote, just get all this aid to Ukraine, a one-time or sort of initial payment to Israel in the $15 billion range, some aid to Taiwan, and then money for the southern border. And of course, anytime you bring up the southern border and recognizing that the House Republican Conference is really disinclined to pass Ukraine aid, we have an immediate stop to all negotiations. So that big wholesale package is probably not going to proceed. I would encourage investors to watch Minority Leader Mitch McConnell. He is a member who has had inordinate clout in the Republican conference for many years now, decades even, and that is coming to an end. And so what you're seeing is that even though he supports that $64 billion basket of aid to Ukraine, he doesn't have the ability to carry the full weight of his Republican conference with him, as there are 5, 10, 12 Republicans who are morphing into sort of the progressive camp of the Republican Party. And that's complicating his sort of legacy efforts at being a global diplomat, if you will, and really focusing on Ukraine aid and NATO and shoring up that important relationship. But we're not going to get that basket, I think. And instead, what you'll see is an immediate resumption of negotiations, which were in place at the end of last year or the last weeks, but really have stalled off. And we'll probably be looking at smaller baskets of aid. Instead of one lump sum of $110 billion, you maybe get $15-20 billion at a time every couple of months into all of next year.
And Henrietta, while I have you, I want to switch gears here and talk a bit about the election, because the Iowa caucuses are kind of coming up as well here. I think January 15th. And we know, Henrietta, Trump has had a consistent lead in the Iowa polls. I just was hoping, Henrietta, can you just bottom line this for us? Is it going to be Trump and Biden in 2024? Is that it? Can we say it's done at this point?
I think it's done. I think it's been done for a very long time. You have 4 Republicans in the presidential wing who are barely hitting 30% collectively in the polls. I mean, Trump has a lock on the party. He has, anywhere between 70 and 88% of the Republican conference voter base very willing to vote for him. I think at this point, his campaign is really trying to manage expectations. So if he wins by 15 points instead of 33 in Iowa, or by 10 points instead of 40 in South Carolina, it doesn't come off as a loss. None of the candidates, whether it's Nikki Haley, Ron DeSantis, Vivek Ramaswamy, or Chris Christie, are even getting close to him in any of the states, including, most importantly, probably South Carolina, where Nikki Haley obviously hails from, or New Hampshire, where Chris Christie is betting all of his chips. I mean, these candidates don't have a chance.
So, Henrietta, I mean, we could spend a long time going back and forth about then what's going to happen, but I'm curious, you gave us some things to watch out for regardless of who wins the presidential election in terms of what investors need to be watching. One of the important ones is tax policy. Walk us through that.
This is the biggest deal that it has been since 2017. You're going to see tax rate legislation in 2025. It's a guarantee. That's whether Biden or Trump is in office or anybody else. This tax bill has to be written. It's mandatory. And as a just pure basis of where we are, just keeping the tax rates the same, not authorizing cuts to corporate rates or individual rates, just keeping rates the same for individuals into 2026 is going to cost $2.3 trillion. So for your international investors, I tend to get a lot of questions from our international clients about, hey, when is federal spending going to come down? When are Americans going to really focus on the deficit? And the short answer is not soon. We have a 2025 bill that must be written that just to keep things status quo needs to cost $2.3 trillion. So there will be additional deficit hikes, and there's potentially going to be some new sources of revenue. One of the pieces that's on the docket is the entire managed funds industry, whether that's cap gains and dividends, whether that's carried interest. whether it's the ability of investors or hedge funds rather, to play in the hospital space or real estate, restrictions on that. You've seen various pieces of legislation come up in the last just couple of weeks, already giving you sort of red flags around the sector. So I think tax policy is guaranteed to be a huge package in 25.
Well, I'm sure we'll continue to talk to you about it. And thank you so much for your perspective. And I think there's not a lot of attention being paid to that by investors, so appreciate it. Henrietta Trays, have a great new year. Good to see you.
Thank you, you too.
Coming up, closing bell on Wall Street. We're checking in on the latest market moves and the top trending tickers. Stay tuned. There was the closing bell on Wall Street. So let's do a quick check of the markets here as we close out this Wednesday. We are seeing all three major averages in the green here. Is the S&P 500 in the green enough to make it a record close? Alas, no, for the bulls. It's not quite there. 47.9656 is the number to beat. So getting a little closer there as we see this traditional Santa Claus rally continue, but not quite there. The Dow, though, did close at a record. I believe it certainly touched it on an intraday basis, up 1/3% on the day, 112 points. And the Nasdaq up almost 0.2%.
Yeah.
So, we are seeing some gains here, a little bit of momentum here during this last week of the year, as we tend to have, because it's the Santa Claus rally.
Craig Johnson over at Piper today, he to his clients pulled out an old Wall Street adage: you never short a dull market. Meaning trading's light,
right?
You don't get a lot of headlines, stocks often tend to melt up.
Yes, well, that seems to be what has been happening here at the end of the year.
Yeah.
Yeah.
All right, let's talk about yellow metal. Gold prices touch a 3-week high as it pushes closer to the $2,100 mark. So advancing here, up about 14% this year, and that would be its first annual increase in 3 years, Julie. Touched a record, remember, $21.35 an ounce earlier this month. Mm-hmm. Traders obviously looking ahead, and they're saying, hey, you know what, we're going to bet on those Fed rate cuts next year and a weaker dollar.
Yeah, and we have seen, if you look at the CFTC positioning, Commodities Futures Trading Commission, they track net positions in commodities, including gold. And what we saw last week was an increase in bullish gold bets by about 20,000 to just over 131,000. So it's not, the net longs aren't as high as they were, say, 2 years ago, but we are seeing them start to climb up as we see prices climb up here. And of course, the irony here to some extent is that gold tends to be the place to go when people are worried, right? And yet, what we hear is a decent amount of bullishness out there when it comes to the economy, when it comes to stocks. And so it's interesting you're seeing this move into gold prices.
You also might have some seasonals working for you too, because January is when you can see dealers in China kind of stock up ahead of the Lunar New Year holiday. So maybe you look out for that too, whether that kind of offers a tailwind.
Yeah, maybe so. Let's talk some biotech, shall we? We're looking at shares of Cytokinetics surging after the biopharmaceutical company said its experimental heart drug improved exercise capacity in a trial. The results placing the company on track to compete with treatment from Bristol Myers Squibb. And, what's interesting is you see these big moves in some of these companies, right? In these biotech companies in particular, it is not that uncommon to see this kind of movement. But this one is a big one, even by these standards. This company is relatively highly shorted. Also, about 14% of its float is shorted. So that could be, we could see a little bit of a short squeeze exacerbating this upward move here. But nonetheless, when you have these companies that have experimental drugs, if there's something positive, then there tends to be speculation raised about somebody coming in and scooping them up.
Yeah, it looks like the company does intend to submit the drug for clearance second half of next year. And there have been reports, too, that this one is an acquisition target.
Yeah.
So apparently interest from Novartis, from AstraZeneca. This is from reporting in Deal Reporter. So wait and see whether that happens. That's another potential headline.
Exactly. And we have seen already some end-of-year activity.
Oh, yeah.
So
people pulling out the checkbooks.
it feels that way.
Got the cash, put it to work. All right, finally here, shares of Iovance Biotherapeutics dropping after the Food and Drug Administration places a clinical hold on its cancer therapy trial. So this one, Julie, following today's trade, FDA, it sounds like pausing a study of its lung cancer drug. And it does, according to reports that I was reading today, it does follow a patient death. And FDA told the company, listen, stop the trial. And from what I read here, companies developing an approach to use the body's own immune defenses to attack solid tumors and kind of considered an experimental approach. And the death was apparently reported in a mid-stage trial in patients with non-small cell lung cancer who haven't, I guess, been responding to other drugs. Companies saying it is working with the FDA to safely resume trial enrollment as soon as possible.
Yeah, if I'm understanding it correctly, it's the process that patients have to go through before they receive the treatment, and that's the step at which the death occurred. Again, if I'm understanding it correctly here, analysts did say that this is perhaps only a slight setback that will be resolved over time. Like Cytokinetics, this is another heavily shorted stock. About 15% of its float is shorted here. The stock is up more than 80% year to date. And as we were just talking about, there has been a lot of M&A activity. A lot of it has been within the cancer space specifically, as a lot of these small biotech companies do vie for new promising treatments.
Lots of bullishness on this name, by the way. Most analysts, 93% of those covering this name are bullish. 13 buys, 1 hold, no sells.
That is a lot of bullishness.
Yeah.
All right, let's move on to another stock. This one might be a little more divisive. It's Tesla. The shares are jumping. We did have a batch of upbeat news driving sentiment on Wall Street, including a note from Morgan Stanley's Adam Jonas. Pras Subramanian's here with the details. And we were talking a little bit about this note earlier, but it's very interesting that he looks at this company, and I guess he has for a while, as bigger than just cars.
Yeah, beyond an auto company is what he's sort of saying. There's a way to drive his bull case, I guess, for the shares of the company next year in 2024. Looking ahead to things that are non-auto, non-core is what he says to the business. And it's funny because he mentions in the note later on that he has got significant pushback from clients about this, and he still says, hey, you know what? No, I'm a true believer in this stuff. Like, for instance, Optimus robot, Tesla adjacent technology, tech that could upend the label market. Dojo supercomputer, we've talked about this before. The supercomputer that can be used for any number of purposes like AWS, in that sort of a realm of possibilities for the Amazon, sort of, huge EBIT mover with AWS. Also noting their edge AI. Imagine your car is a robotic edge AI device. Beyond just collecting information for FSD, imagine the key for your car is a phone, for instance, a Tesla phone, right? Stuff like that. I also want to note the EV infrastructure kind of boost there. As GMs and the Fords of the world pulled back on spending, Tesla can step up on new spending for AI, for FSD, for their supercharger network, which they're using legacy OEMs for, that sort of thing.
And how much prizes also the bullishness there, because is his bet also in part he's looking at rivals who are kind of pushing out these EV-related investments and saying, okay, that's runway for Elon Musk?
Right, as the legacy guys pull back, gives you an opportunity to push in and spend more and gain more market share in those Tesla car adjacent stuff, right? Software, supercomputing, and the EV infrastructure stuff, like the charging networks we're talking about. That's sort of a big deal there. But I just want to note that it's funny because not funny, but it's his model for 2030 and beyond includes these services as being a huge factor in Tesla's profitability and revenue growth there. So it's something that we've seen other bulls like Dan Ives talk about that as well. It's just so far out that I think that's why clients are saying, hey, what about next year?
Well, next year he says auto margins are going to go down.
Yeah,
They're going to be lousy.
Potentially negative operating margin, which is that's first I've heard of that, but he's still noting that and saying, hey, you know what? Look to the long term, not just 2024.
All right.
I'll
Keep
see.
an eye on it. Pras, thank you so much.
We'll have to get him on here to defend it, actually.
That's a formal invitation.
Someday.
Yeah, right. Meanwhile, while investors have been waiting for a recession to hit for the better part of the last year and a half, markets have remained strong. The Dow as well as the S&P 500 are nearing all-time highs. So is it possible that this is just the calm before the storm? Let's welcome in Reese Williams, Spouting Rock Asset Management Chief Strategist. Reese, good to see you. Listen, the market has enjoyed a strong rally here. You think, too fast, too much, Reese, or does it make sense to you and we continue the good times right into 2024?
Our base case is we're going to continue into 2024. However, this has been a strong month and a couple of very strong months. So some sort of pause here in January would not be a surprise. But we do think it does appear that the possibility that we have low inflation and no recession in 2024 could stimulate the market broadening and stocks to do fairly well.
We keep talking about how we're flirting with record levels for the S&P 500, Reese. Do you think, we're not far from there, but do you think we're going to get there? And then does that run keep going?
I do. And I think the biggest reason that I'm excited about the market is just the power of AI. And I remember 1994 and 1995, the last time interest rates had been risen dramatically and no recession occurred. And then the reason for that really was the power of Cisco technology with the client server technology and then the internet. So that had a productivity boom, which allowed for a really strong economy, really strong stock market. And as I remember, when we exited the 1990s, we even had a government budget surplus. So I do think that is a possibility, certainly a strong possibility, that we're going to have another sort of AI-led productivity boom over the next couple of years.
And Reese, more in the near term, too, we have this other potential catalyst for the market here. We got earnings season coming up pretty quickly here. What are your expectations there?
On earnings, I'm a little less sure. And the reason is, if you look at the earnings reports over the last 3 or 4 weeks, they've largely been negative. This rally has not been an earnings-driven rally. It has been an interest rate-driven rally, as we have seen the consensus go from interest rates are going to go higher at the end of October to interest rates are going to be here or go lower now. So we've gone from the 10-year from 5% to 3.9%. But if you look at FedEx, you look at Nike, you look at Steelcase, you look at Winnebago, everybody has been lowering numbers a little bit. MasterCard announced that their sales were going to be a little bit lighter than they had expected for December. So I'm not thinking this is a big earnings recovery. I think right now it's really about interest rates, and that's going to drive the market. And hopefully the AI productivity I'm talking about helps you in the second half of the year.
The focus this year was a lot on the Magnificent Seven. There's a lot that has been made of a broadening out from just those stocks. They're also participating in the rally. Do you think that continues? Do we see, the AI group, for example, continue to dominate, or is it going to be more broad?
Well, and by the way, on AI, I think it's AI going throughout the economy. It won't just be the AI group, quote unquote. Though we expect, NVIDIA sitting there at 25 times earnings, we expect that could have another good year potentially in 2024 as sort of the leader of AI. But I do think that small caps should continue to outperform in my base case scenario of no recession and low inflation. But if anything goes wrong with that thesis, which there's a lot of things that could go wrong, meaning war breaks out much more strongly in the Middle East, oil skyrockets, we do have a recession. I think you pointed out earlier that we might be in the lull before the storm. Pretty much every time there's a recession, people think that we're going to skate through without one, and then 6 months later we find out we're in one. So there is things that could go wrong. On the other hand, if things go as according to plan, like I expect small cap stocks will outperform, and they're absolutely and relatively cheap.
And Reese, for long-term investors who are listening right now, does the classic 60-40 portfolio, Reese, does that still make sense to 60% stocks, 40% bonds, still the way to go in your opinion?
You know what? I might go, and this is just for right now, I might go 55, 35, 10, leave some cash. You're still getting 5%. the bond market's predicting that's not going to stay 5% that long, but for the next 6 months you probably get 5%, and then you have some money to deploy into any kind of uncertainties that develop here in the first half of the year. But I think the general idea of a 60-40 ought to work well, and I think more importantly, 2022 was a bloodbath. We lost money in stocks, we lost money in bonds. The 60-40 just didn't work. I do think even if I'm incorrect that we do fall into a recession, your bond portfolio should do pretty well in a recession. So I think that natural ballast should occur, even if I'm incorrect and the market is not ebullient in 2024.
And Reese, are there particular equity sectors that you like going into next year?
Well, getting back to the broadening of the market, we mentioned small caps. We also like energy and we like REITs. Energy also, you saw gold doing very well. I know that was highlighted on your show. With the dollar falling, we think energy and oil prices ought to do pretty well. It's at $70. We think the Saudis defend 70. They're refilling the SPR. There's a lot of positives, and then there's that insurance policy. If anything goes spectacularly wrong in the Middle East, oil's going to be a very strong performer. So we like oil here, and it's been one of the few underperformers in the last couple of months. We also like REITs, and we would not try to figure out what the best office stock is. We would stick with the secular winning real estate classes like industrial, like healthcare, like triple net, because we don't think that they've experienced enough of a bounce given what's happened in the 10-year.
And Reese, in the equity market, you were mentioning those sectors you like. What would you avoid in 2024, Reese? What doesn't look attractive to you?
Well, that's an interesting situation. I think companies without earnings are ones we would tend to avoid. And the reason for that is if anything goes wrong, these stocks have had a nice rebound here in the last couple of months. Anything goes wrong with the economy, and either we have too much inflation or we have recession, those kind of companies will really get pounded. So I think I would kind of steer clear of those. But in general, I don't think the market's way overvalued, and the stocks that are expensive, like the Magnificent Seven, are there for a reason. They're magnificent for a reason. They're wonderful businesses, and they're unlikely to crater even in a softer economy.
Reese, always appreciate your time and your picks for our viewers. Thank you, Reese. Appreciate it, and Happy New Year.
Thank you.
And coming up, the race for crypto dominance is on. As firms await spot Bitcoin ETF approval, but when it is passed, who will win the Coin-Tucky Derby? More on that when Yahoo Finance returns.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question. What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, three things that you need to know.
We just got the announcement.
What happens now?
Now, I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Millions of Americans getting raises next year as 24 states will see their minimum wage rise on January 1st. In addition, 38 cities and counties will also increase their minimum wages. Here with how this will impact the job market, we have Chris Thornburg, Beacon Economics founding partner. Chris, thank you so much for joining us. From what I understand here, Chris, so 22 states increased the minimum wage, and raising pay for nearly 10 million workers in total. Workers, from what I understand, apparently receive about $7 billion in additional wages. Chris, does this make sense to you? Just good economic sense to you?
Well, look, there's a lot to unpack here, but let's go to the bottom number. The reality is most workers make far beyond what current minimum wage laws would suggest. As a result of that, when we hear about these hikes in minimum wage, we have to keep in mind that most folks aren't impacted by that. And in fact, most parts of the economy aren't as well. There are, of course, a few places that get hit excessively by high minimum wages, probably places in our economy that would not surprise you. Personal services, nursing homes, childcare, and of course, restaurants. These are places where these higher minimum wages costs cascade through and of course create higher costs for consumers on the other side of it. Overall, again, it doesn't really move the needle. It does have some consequences. One of the things that's very frustrating for me as an economist is we know that this particular tool doesn't have, very good results. And as a result of that, we probably should find other ways to alleviate poverty in the United States. Yet here we go again, year after year, we see this played out.
Well, what do we know about how it does and doesn't work? I mean, for the individuals who get more money, probably a good thing. But then have we seen in municipalities, for example, where we've seen a big lift in the minimum wage? There's always threats that, we're not going to be able to employ as many people if we are forced to pay this. Is that, in fact, what ends up happening?
Well, again, kind of go back to what I was saying at the beginning of this thing. Most workers, this really has no impact on, right? It's just a small subset.
Well, is there not a ripple effect, though, even amongst workers who make more?
Oh, a little bit of one. There's no doubt about it. Perhaps let's talk about California, because where I live, of course, is we are on the far edge of it. Here, the minimum wage is above $15 an hour. That starts cascading through and even makes your minimum level to say, be a manager as opposed to someone who is eligible for overtime, that goes up as well. So yes, here it's a big deal, as the case may be, cascading across the labor force. But for most of the nation, the minimum wage is significantly lower than it is here in California.
And Chris, as we head now into 2024, listen, things are uncertain, right? For the economy, we can debate whether it's just going to slow or whether it's going to actually tip into a downturn. Lots of smart people have different opinions about that. Some of your colleagues, I'm sure. I mean, if it slows enough, frankly, it's going to feel like a recession to a lot of people. Against that uncertainty, what are the risks, Chris, against that backdrop to raising the cost for business right now?
We've never been on the recession camp right from the get-go. We think a lot of these worries about the future of the economy are highly overstated. We see continued growth. And actually, the biggest problem in the United States right now is labor shortages. We don't really you see that in this kind of conversation, but the reality is there aren't enough Americans out there. There's still 1.5 job openings for everybody looking for a job. When you think about it from that way, I'm not worried about a downturn. But if a downturn does show up, and it inevitably will, you're absolutely right. High minimum wages create less of an ability for the labor market to respond to that downturn. And ultimately, that can make the damage worse for the economy, makes it harder, shall we say, to navigate that particular downturn. Look, here's the bottom line. We want to reduce poverty. This tool is not effective. We need to find better
Chris,
ways of doing
what's
it.
the better? You said that before, so I'm curious. What's the better tool then, or tools?
Well, right off the bat, I would argue that we should think about upskilling as opposed to upwaging. When you think about our economy today, you remember all these labor shortages I was discussing, the very low the unemployment rate. Well, for people to really get ahead, you're not going to do it by simply raising this baseline number by 50 cents or a dollar. You got to get them onto a career path. That career path takes skills. So much of this is about making sure that people have the ability to rise beyond these jobs, as opposed to thinking that these really entry-level jobs in our labor market should be sufficient for somebody for a lifetime career of working. It shouldn't be. This is a great job for someone at the very entry level. Help that person rise beyond the job.
Is there a percentage increase historically, Chris? We could see the minimum wage, which we know we have the data to say it kind of makes sense, meaning it's enough that it makes a difference to the worker, but it doesn't convince, let's say, the small business owner to say, you know what, forget it, I'm just not going to hire.
Again, remember the market equilibrates, right? So take the case of minimum wages here in California. The higher minimum wage doesn't mean that restaurants can't survive. There's lots of restaurants in California, but there are fewer than there would have been but for the high minimum wage. And perhaps more importantly, for anybody coming out of the state, coming into California, first thing you're going to see is just how expensive food here is. Well, remember, the high cost of that food is driven, of course, by that high minimum wage. In other words, it's not a quantity of jobs conversation. It's really costs on the other end. Ultimately, it's the consumer who pays a higher minimum wage in the form of higher prices. It's not really about the unemployment rate.
All right, Chris, we got to leave it there. Thank you so much. Really appreciate it, and Happy New Year to you.
And Happy New Year to you, too. Thank you.
Thanks. Coming up, we've got more Yahoo Finance coming up after the break. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
We'll be getting a clearer picture for the future of the spot Bitcoin ETF in just a couple of weeks. Regulators make a decision on whether to allow the ETF by January 10th, and experts are expecting the green light. Well, here to give us more insight on the potential new spot Bitcoin ETF, we now bring in Cahill Gordon Reindel partner Sam Enzer and Bloomberg Intelligence senior ETF analyst Eric Balchunas. Guys, it's good to see both of you. Sam, I'll start with you. Listen, the spot Bitcoin ETF, Sam, we've been talking about it a lot of excitement, at least from crypto fans. Do you think it's coming, Sam? Is the SEC going to really green light this product?
Yes, I'll begin by saying, with that question, I'll begin by saying that everything I say here is not investment or legal advice. This is just my personal opinions. But I do think it is likely that you're going to see the SEC green light a bunch of applications to offer Bitcoin spot ETFs. I think it's finally come. I do think that the date you'll see, the last date possible would be January 10. That's based on when some of the applicants filed, and I think the first one was ARK, and that's what that January 10 date comes from. And I think in terms of why do we think it's likely? First, my co-guest here, Eric, who I follow closely, and I'm honored to be on with him and others in the market, many analysts covering this. I think it's fair to say there's a consensus that it's likely to happen, and that's based on two things. One, the SEC lost a significant case in court in a lawsuit brought by Grayscale. Grayscale got the DC Circuit Court of Appeals to rule that the SEC's prior denial of Grayscale's application to convert their trust into a spot Bitcoin ETF was arbitrary and capricious. So that's set in motion the course we're on now. A bunch of major players have filed applications to list, including BlackRock, Galaxy Digital, Fidelity. These are major institutions. They're legitimate institutions. They have serious compliance, and they're the kinds of institutions that could offer a reliable, competent product to the public. And then if you look at public SEC filings, there has been a bunch of filings indicating that the SEC has been commenting down into the weeds of how these spot Bitcoin ETFs would work, commenting on things like whether or not they would settle in cash versus in kind. These are the kinds of details you wouldn't expect the SEC staff to engage on in a holiday week unless they were serious about approving a spot ETF.
Yeah, makes sense. They wouldn't be working so hard unless they had to, unless it was coming down to the wire, Sam. Eric, let's get you in on this. What do you think? I mean, you cover the ETF industry very, very closely. Presuming that we get approval here, and I believe you're in the same camp as Sam, what is going to be different about these ETFs? What sort of special boxes are the issuers going to need to tick to get these approvals?
Yeah, we have a note out today saying that just making it to the starting gate is half the battle. It's sort of the race before the race. And what we're hearing is, as was just mentioned, the big thing the SEC was concerned with was in-kind creation redemption. They don't want that because that means broker-dealers and unregistered broker-dealers touch Bitcoin. They don't want that. Cash creations is more of a closed network where only the issuer touches Bitcoin. So you have more control with that. It's not as great for the investor, but I think largely it will be unnoticed by the end investor. So that's step one. Step two is the harder part. That is to get a signed agreement with an authorized participant. Every ETF needs an AP, somebody to step in, provide liquidity, do creations, redemptions. And we are hearing that not everybody is getting those signed yet. And we're basically, 24 hours before, 48 hours before the S1s are due. So I'm hearing there's a mad scramble as we speak to get, a Jane Street or a Virtu to sign on for each of these ETFs. So it's possible not all of these issuers even make it to day one. And if they don't make it to day one, unless you're BlackRock or Fidelity, you might as well forget it.
And Sam, another question I had have there been any kind of changes in the spot Bitcoin market itself, Sam, that has regulators perhaps more comfortable with green lighting this product, or no, it doesn't have to do with market conditions? This is just, frankly, the SEC in some sense is boxed in here.
I think it's that the SEC is boxed in. I think that my personal view is the Bitcoin spot market is mature at this point. Bitcoin has been around since 2009. There are very well-developed spot markets in it. You've had Bitcoin future ETFs that have been approved for, I think, around 5 years. So the market for Bitcoin has the depth and the liquidity to ward off things like manipulation. This is a legitimate asset class. With the court ruling in the DC court in the Grayscale case, and the fact that institutions like Galaxy, BlackRock, Fidelity getting in, you see that this is a serious market. The SEC can't ignore it anymore, regardless of SEC Chair Gary Gensler's position against crypto generally. But I will say, to the extent there has been some change, I do think after the Grayscale ruling, after it became clear that it was almost inevitable that some type of spot Bitcoin ETF would have to be approved, I think you've seen much more serious institutions get into the space. Many of my clients are institutions that you would see in traditional finance, who have the record of the reputation and the record with regulators like the SEC. They can offer a product that consumers can be confident in, that offer the type of investor protections that the SEC likes to see. And so those types of institutions, the Galaxies, the Fidelities, the BlackRocks of the world, are here. They're offering a real product. And so I think to the extent that there has been a change, you could say it's that.
Eric, the note that you referred to, you referred to the Cointucky Derby amongst these different organizations trying to get approval. But after that, they then have to attract assets. And we yesterday had this chance to talk to Kathy Wood of ARK Invest, who of course is one of the entities that is trying to get approval. And she gave me her sales pitch for why she thinks ARK is well poised to attract assets. I want to play for you what she said.
This is no secret, but we've been doing research on Bitcoin since 2014. That was our first paper. And as others were naysaying it, we were out there banging the drum saying, this is a new asset class.
Right. So basically what Kathy's saying is they've been bullish on Bitcoin. They have a deep expertise in it. She also mentioned that they have partnered with 21 Shares, which is an exchange-traded product issuer that has spot products in Europe. How do you think they're going to fare? Who do you think is going to get the most assets here?
Yeah, look, there's going to be really two general factions here. There's going to be the people who say, we're really crypto people, not like these Wall Street opportunists like BlackRock and Fidelity. Bitwise already has a commercial out that says crypto specialists. And so those are the firms, and I would say the same thing if I were Kathy and 21 Shares. They really do care about this space. You could argue the big guys are more interested in making a buck. That said, if you're talking about where the real money is in terms of where for these ETFs, it's in the advisor market. They have about $33 trillion in assets. And these advisors and the rich boomers they serve, they love brand names. And so that definitely, I think, favors BlackRock, Fidelity, regardless of whether people think, in fact, being a crypto specialist may actually not play as well amongst the sort of like over 65 boomer crowd that has all the money. So this is a really interesting race. I do think there'll be a strong middle class where there'll be a couple who have 200 million, 300 million. We've seen this in ETFs, but there's probably only room for one liquidity stud. And that is why this is so important. And if you are the liquid one, the GLD of Bitcoin, you never have to lower your fees. You have pricing power forever. You're immune from the Vanguard effect, and it's a beautiful thing. And that's why this race is so intense.
Yeah, that's what I keep saying. You know GLD, you know USO, you don't necessarily know the other ones. I find it ironic, Eric. I mean, only in crypto would you be having the discussion of the most passionate issuer is the one, you know, that is something that is an advantage, which I think is just so very crypto. But to your point, if the retiree class, if the institutional investor is the real audience for these, then the whole to the moon stuff isn't necessarily going to fly anymore.
Yeah, in fact, if I was BlackRock, I joked on the team that their ad should just be the adults have arrived. Because I think, you know, after FTX and Binance, there's just been like sort of issue after issue. Not with Bitcoin. I think it's an interesting asset for a lot of people. It's the intermediaries. And not only that, besides some of the shady activities and FTX fraud in general, you have the idea of really high commissions. And so I think you get a BlackRock involved, it's going to trade at 1 basis point. It's a trusted brand. I think the fee could be between 40 and 70 basis points. somewhere in there, which isn't bad, and you have all of the sort of the SEC stamp on it, that could be very appealing to, again, the boomers. But you have to remember, they have all the money. Not all the money, but most of it. And that's why the tickers are also very sober. I mean, IBIT, BitB, BTCW, there's only one or two real fun ones, and you could have all fun ones. So I think this is really a product that's aimed at the financial advisory and sort of the traditional finance era of crypto.
Eric, on a separate note, I want to get your take on sub-analysis. We had Coinbase CEO Brian Armstrong on Yahoo Finance, and he makes the case strongly, Eric, that, in his opinion, the U.S. is really falling behind here on the regulatory front when it comes to crypto versus, other parts of the world. I want to get your take on that, Eric. Did you agree with that? If you do, what explains that, and do you expect that to change?
Yeah, well, I don't know. I mean, the U.S. is, I hear that. And this is one of the theories we heard on why Larry Fink was so interested to get involved. He felt we were losing on the world stage here. I think that this will help a lot. I can't overstate the importance of an ETF. I have to talk to my crypto followers all the time about this. They're like, well, why not just get a cold wallet storage and do it yourself? The ETF is very easy. It's convenient. It plugs into every single portfolio and technology out there, especially, again, for advisors. It's a bridge. It is a bridge between crypto, Bitcoin, and probably Ether, and regular investors. And it's a trusted bridge. So I think once these bridges are set up and there's traffic going back and forth, it'll actually help crypto. Honestly, the SEC should have allowed in-kind, because the more you get market makers having to deal with the exchanges, the more the exchanges are going to get up their game, because they're going to want some of those big dollars that the market makers will bring in via the ETF. So in my opinion, the SEC is short-sighted by doing cash only. They should want to unleash the ETF ecosystem on the crypto underworld. That would only help it even more. So, but yeah, all of this I think is helpful to get the US up to speed, because there's spot Bitcoin ETFs in like 7 or 8 countries at this point.
Sam, just real quick, wanted to get your final thoughts on that matter, as well as to how far maybe the U.S. needs to go regulatorily, just in 30 seconds if you can.
All I'll say is I think I agree with what Eric has said, and I think that we're moving in the right direction. We're not going to get everything we want from Chair Gensler, but look, if we get approval of a Bitcoin ETF, that's a legal wrapper that allows financial advisors to market and offer a Bitcoin product, a way to get investment exposure to Bitcoin to all of their clients, retail, retirees, etc. In May, you have another deadline, which is the deadline for approving spot Ether ETFs. So that could be another landmark in opening up exposure to the crypto asset market as a legitimate investment class to a broad swath of investors in the US market. So it's incremental. It's not as much as I would like, but I do think we're now starting to see some real progress.
Guys, thank you so much. Really appreciate you joining us on this holiday week, and Happy New Year if I don't talk to you. Sam Enzer and Eric Balchunas, thank you.
Thanks very much for having us.
Thank you.
Well, on the other side of the break, we'll tell you everything you need to know to start your day tomorrow. Stick around. Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced? How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings.
And they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Taking a look at what's on tap for Thursday, initial jobless claims from last week are out ahead of the open. Estimate is 215,000. That would be an increase of 10,000 claims from the prior week. Mortgage rates set to be updated tomorrow afternoon as the 30-year rate will look to remain under 7% for the third straight week. So our lower rates bring in potential home buyers back on the market. We will find out when the pending home sales index comes out on Thursday. Sales fell 1.5% in October as the average rate on the 30-year mortgage surged to its highest level in over 2 decades. But economists predict that home buyers may make a comeback. The expectation is a gain of 0.5% last month. And as someone ready to win big, Powerball jackpot rising to roughly $700 million after there was no winner in Monday's drawing. The next drawing is on Wednesday night, and the estimated cash value of the prize is $352.3 million, according to Powerball.
I would venture to say everyone is ready to win that kind of money. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a great one.
The rise of electric vehicles making its way into the ultra-luxury space. Pininfarina, an iconic name in Italy, making an electric hypercar with a $2 million price tag. I recently sat down with the company's CEO, Paolo De Lacca, and spoke to him about the company's growth, even if it's not about volume.
We are now in a phase where our production ramp up, of course, is a niche segment. It's a very rare product that we offer only to exclusive clients, and therefore you cannot think about a huge volume. It's actually quite limited volumes, but this is in the essence of our business product and our, let's say, business strategy to stay in the luxury segment. Is definitely a lot about technology, about performance, but still the key elements of Battista and every Pininfarina we will also develop in the future start and originates from the vision about the design.
So, Paolo, you mentioned niche vehicles, luxury vehicles. You also unveiled the B95 hypercar, coach-built, only 10 examples. Looks stunning with that roofless design. What's the reaction been to it? And are you surprised, this is the big part, customers want to pay millions of dollars for an EV?
Well, we were quite happy with the overall reaction. not only from customer, but also from media and fans, when we displayed for the very first time B95 at Monterey this year. There was a private unveil that was anyway soon broadcasted on the 16th of August, and then the car was brought at the Quaid in Monterey on the 17th. And it was quite amazing to see the reaction of the people. In this case, B95, which stands for Barchetta 95, therefore celebrating the 95th anniversary of the brand when the first car will be delivered in 2025, is actually our first project where we are developing a few of over the platform that is shared together with the Battista. So the performance is still the one deriving from the Battista, which will be even brought to a further extreme level. The car will be lighter and will be tuned in a way to really provide the ultimate driving experience, even more when it will be an open sky driving experience. I think that our customer go beyond the car being electric. I mean, being electric is more about the technology, is of course a lot about our commitment when we start this journey. Pininfarina itself didn't have any legacy in the combustion engine, so we decided already 5 years ago that for us it was about embracing the future and also embracing the technology that not only allow us to have a car which is emission-free, is also allowing the car to have the highest level of performance that you can now achieve today, and this comes with electric, both in terms of maximum power, but also in terms a lot in the way of how the power and the torque are delivered, in the unique case of Battista by 4 independent motors, so realizing the ideal torque vectoring, which results in something that is not only ultra fast, is also ultra fun to drive.
You know, prior to you being CEO, you were a chief product and engineering officer. So you've been working underneath the skin with these vehicles, putting them together. When we talk to EVs as opposed to regular cars, you know, what are the main challenges with developing these vehicles and bringing them to market for a company like yours?
Well, in a way, the challenges are different. In a way, the challenges are similar to the one of another vehicle with another technology. So there is a lot of pre-development that is done since the beginning, while the design is in the concept and evolution phase on a virtual base in terms of overall simulation, CFD, handling. We even use for Battista a full virtual simulator to start to pre-tune not only the power and performance, but also the chassis, the suspension, to develop the best possible balance with the tires. And then following that, you start to go in a testing phase with the early prototype and later on with the pre-production vehicles. Now, in an electric vehicles, the elements and the system are in a way different to be addressed. Basically, you can imagine that the real motor in an electric vehicle is the battery pack. So that's where really lies most of the technology and really lies most of the development when it's about, from one side, to develop the highest level of power and energy, and from the other side, to also contribute to the highest level of reliability and durability of the system, which are really something that are in relation with the technology of the module, which is encapsulating the cells, and the software, which is overall supervising the use of that power and energy. So from one side, I could easily tell you that in an electric vehicle, software is really a key dominant part, not only for the human-machine interface, but also for the overall handling of the power and energy, including the life protection of that vehicle.
My thanks to Paolo De Laca.